Well, a massive case of eurosis plaguing the markets today. Here's the setup right now as we count down to 2 hours to the closing bell. Investors are anxiously awaiting any word from Standard & Poor's about downgrades coming for credit ratings on sovereign debt in Europe. There's a lot of rumor out there, a lot of talk, a lot of chatter about what is going to be done. But as of 2 p.m. Eastern, still nothing concrete from S&P. So as of right now, here's where the credit ratings stand from Standard & Poor's on some of the sovereigns in Europe. You've got Portugal, BBB minus, right? Very bad credit rating. There's talk that could take a hit. You've got Ireland, BBB plus. Italy, single A. Greece already cut multiple times. Greece sitting on the worst in the Eurozone with a double C, at least of the major countries. Spain, double A minus. Here are the concerns. Germany, AAA. No talk around Germany right now. That's the big boy. The second biggest, France, and yes, the FT and French paper Les Echos both reporting that S&P may cut France's credit rating from that vaunted and rare now AAA down to a AA. So here's where we stand in the markets right now, and what the talk is, guys, is that S&P will cut sometime later today France by 1 notch to AA, and Spain and Portugal by 2 notches. But again, important to note, these are just reports in various papers. There's a lot of trader talk. If they do occur, though, could happen at any time, so it could be a wild next few hours for the markets. Mandy.
Indeed it could. So I guess the question is, what does it all mean? Where do we go from here? Joining us now by phone is noted investor Marc Faber of the Gloom, Boom and Doom report. Marc, great to have you on the show. Do you feel that all this ratings action or potential ratings action is really just catching up with reality?
Yes, because the market has already downgraded some of these sovereign issues. And I think when the news will come out, it will be old news, so it won't have an impact on the market. But having said that, the market has had a huge rally from the October 4th low when the S&P was at 1,074 and is now overbought. And the volume figures were very poor. The advanced decline line wasn't particularly good. Every day we have some stocks that are breaking down. This is not typical of an emerging bull market. It's rather typical of a rebound within a bear market.
You know, we will get further into your outlook for stocks in general in just a moment's time, but I just want to bring you back to Europe, because obviously when the US was downgraded, it really didn't affect demand for US treasuries at all. If anything, demand went up. So will we see any noticeable effect, negative effect on demand for Eurozone bonds, or again, is that already priced in?
I think it's already priced in, and I think what has happened is through backdoor actions, the ECB is already monetizing. Because if the ECB wasn't monetizing, then the euro would be strong. And they have increased their balance sheet and so forth. So I think that much of any downgrade is already priced in. The question is whether the downgrade will be sufficient, is my opinion. Most of the European countries should be triple Cs, and the US should not be a AAA minus, but a triple B or a junk bond when you really analyze the unfunded liabilities that will come to you in future.
Marc, it's Brian Sullivan. You know, you and I have talked a lot over the years. I agree with a lot of what you say, but I got to take issue with that. You think that all European nations should be triple C? Germany deserves a triple C?
But most of them.
Are the only ones that matter France and Germany?
Actually, France is not a very good credit in my opinion. Germany is okay, but Germany also has very large unfunded liabilities.
How would you rate France, Marc?
Well, I'm not interested in sovereign bonds except as a trade. But I think longer term, you're going to lose money on sovereign bonds.
Marc, I'm just going to break in here because it looks like the French finance minister has said that S&P downgraded France by 1 notch. As Brian was saying earlier, this was the speculation. And yet many feel, and I'm sure you are in the same camp, that 1 notch just is not enough. At least 2 notches should be the downgrade here. You know, France is in far worse shape than the US. They only got a 1 notch downgrade. France is at the epicenter of the Eurozone crisis. They're not in control of their currency. Is this just not enough? 1 notch only?
In my opinion, it's insufficient. But, you know, different people have different views. I wouldn't buy any French government bonds, and I wouldn't buy U.S. government bonds here either. But I admit that last year, to the surprise of most fund managers, 30 years U.S. Treasury bonds gave you a return of 30% per annum. So you had a huge move in Treasury yields on the downside, and so you had a tremendous capital appreciation on the bonds. And the 10 years appreciated by more than 10%. And I was kind of wrong about this, that I admit. But I just wouldn't buy them as a long-term investment.
Mark, don't be hard on yourself. You certainly weren't the only person wrong about that. As we led up to the S&P downgrade, a lot of people said, hey, it's going to crush our debt, interest rates will spike, America will be in big trouble. We saw the opposite. Demand for U.S. Treasuries actually rose. So if we get these downgrades in Europe, as it looks like we're going to get at least in France, according to the breaking news out of the French finance minister, will it even matter?
I don't think it will matter much. It will matter to the value of the euro. And I think the euro is basically in a downtrend. Having said that, the short positions in euros are very large, and you could get a counter-trend rally. Maybe we're now at around 126.50. Maybe we can rebound to around 130 against the US dollar. But I think the trend for the euro is down.
Is it good for it to go down, though? Won't it make at least the export side of the Eurozone economy more competitive? I would imagine there'd be a lot of politicians in Eurozone quarters that would be quite happy about it going down.
Yes, I suppose so, but at the same time, the European corporate sector has, of course, a lot of US dollar debts, and that makes it more expensive to service these debts.
When we look at a potential downgrade, say, of France, okay, the market has largely said we knew it was coming, we suspected it was coming, it was maybe priced in, we know Greece, double C, you think they should be worse. Is there any surprises out there that would and should materially move the market? What would be sort of your black swan scenario for Europe?
I think what might move the market if some countries say, we had enough, we exit the euro. And if Greece does that, it's not going to be a disaster. But if Greece, Portugal, Spain, and Italy do it, then it will have a huge impact. But don't ask me exactly what the impact will be. Because if at the end of the day, only strong countries are in the Eurozone, maybe the euro will strengthen. But huge problems will arise in the derivatives market, and obviously the countries that will be exit the Eurozone, they will default.
Marc, just hold that thought. Let's go to the breaking news desk now with Simon Hobbs. What are we hearing from the French finance minister on these downgrades?
Well, in a national address, he has confirmed to the French people that indeed S&P has notified France that it will be downgraded by one notch. He says it's not a catastrophe. They would have preferred to keep their AAA rating. Moreover, he says the markets have anticipated that the downgrade would come. Importantly, the French finance minister goes on to say that labour costs are France's weakness, and that they must keep reforming the country's economy. This is important because the loss of the AAA rating may be seen as a political failure by Nicolas Sarkozy before the French people, and it may open the way up to the opposition socialists winning power at the French presidential election. They might not be in train with Angela Merkel, they might not be so pro-austerity and reform, and were there to be a break between France and Germany, that would indeed be bad news, guys, for the single currency. Back to you.
Okay, thank you very much for that, Simon Hobbs. Let's get back to Marc Faber. With regards to how an investor should be viewing all of this, what is the investment case or otherwise for Europe right now?
Well, basically, European stock markets last year were down between, say, 15 and 30%, depending on the market. And European stocks grossly underperformed the US. I mean, the whole world grossly underperformed the US, which actually in 2011 performed reasonably well. The US was flat on the year, and the utilities index was up and so forth. But the other markets in the world, emerging markets and European markets, were very weak. Now, I believe that sometimes in 2012, the outperformance of the U.S. vis-à-vis other markets will cease, and that you have to move back into quality companies in Europe and into emerging economies.
Are there any particular European companies that you can name?
Well, I think companies like Novartis, Nestle, Total are reasonably good value. I mean, they're not compelling values, but you understand, with zero interest rates, it's very difficult to value anything, and anything that has a dividend yield of, say, 3% compared to zero interest rates is relatively attractive. And I believe in the world, the central banks will keep interest rates below the rate of inflation. In other words, what you will have is negative real interest rates for essentially as far as the eye can see. And in that environment, you want to be essentially in real estate, and you want to be in equities, and you want to be in precious metals.
And one thing from your latest report, Mark, is that you believe that a high-quality basket of U.S. large caps will return 5 to 7% annually for the next few years. So to our audience out there, largely watching in the United States, is everything that is happening, a potential China slowdown, the Eurozone issues, is that potentially a positive for capital inflows into U.S. equities?
Yes, and look, the worse the global economy looks, the worse the Chinese economy collapses, if it collapses. But anywhere where there will be a significant slowdown, there will be a reaction in terms of money printing. And money printing can lift equities, whereas the real economy continues to decline. It's like in the last 10 years, basically in the U.S., standards of living of the average person has gone down. But people that were involved in assets, in real estate, and in equities did reasonably well.
We've got just 10 seconds. You made the case for gold. Okay, we just have to break in here. Marc Faber, thank you very much for joining us today.
It's my pleasure. Thank you. Bye-bye.